It's been a brutal day for some U.S. equity investors. It's Monday, March the 10th, and this is Markets with Megan. If you like this podcast, please subscribe, hit that alarm bell, share it with friends, family, or colleagues. But we're here with you today for another impact report. We did this last week when the tariff rhetoric really started to create some volatility in the markets and start this sell-off. So let's kind of go through three different things. What's happening, why it's happening, and then what we see going forward. So what's happening? What happened today? We got a sell-off in the U.S. tech area. This just exacerbated as the day went on. We're looking at the NASDAQ down about 4% just today alone. It's officially entered correction territory, which is a decline of 10% or more. When you look at volatility in the equity market as measured with the VIX index, you're looking at almost a 30% spike today alone. We're looking at volatility now. You have to go back to August of last year to see the highest level. And when you look at some other areas of the U.S. equity market, you're looking at small and mid-cap stocks that have taken a big brunt of this as well. All of the indices across the board in the U.S. are lower, but if you look at the value side of the market, it held up a little bit better, but you are looking at a lot of profit taking in those high-flying, expensive technology, AI-related names. You're seeing people take profits there. So why? Why is there this volatility pickup? Why is the market so weak? First of all, we talked about this in our first impact report. The uncertainty around tariffs is creating a lot of confusion for companies, whether it comes to investing, valuing, and then investors are having a hard time looking at what impact the tariffs may have on individual company earnings. And that's because the tariffs keep changing every day. But we had often said when it comes to tariffs, if it's a one and done situation, the markets can handle that better. But we're seeing this back and forth and just uncertainty continue and could continue till we get, again, in the beginning of April when some of these decisions may be made with specifically Mexico and Canada. The other reason is this tariff rhetoric and the new administration's policies is clashing with an U.S. equity market that was already very expensive. You were looking at valuations, and what we're talking about is price to earnings valuations that were trading at some of the highest levels we've seen since the dot-com bubble. We have said a valuation correction may be in store. We're also seeing that the economic situation here in the U.S. is deteriorating quicker than most had anticipated. When you look at things like manufacturing, when you look at things like the housing market, when you look at consumer confidence, all of these things are trading at levels that you would typically see leading up to a recession. The point that really got the market, kind of the sell-off exacerbating was the employment report that we gave a podcast on last week. The employment report showed unemployment ticking up modestly. So we're now seeing this spill into some of those lagging indicators like the labor market. We're also seeing from an inflation standpoint that the Fed may not have as much flexibility as they anticipated this year. So that's creating a difficult time for investors. What does this mean going forward? Well, first of all, valuations in the U.S. market, specifically in U.S. large cap, are not cheap enough yet. I know that it looks painful on the headlines, the media is going to make a frenzy about it, and it's not that it's not down. And as we mentioned, NASDAQ is down in correction territory. But the valuation was so overvalued that this is getting to be a healthy correction. We're still looking at U.S. large cap trading at a premium, whether you look at value, whether you look at growth, or the broad U.S. large cap market in general, its price to earnings multiples are still trading at a premium compared to its trailing 15-year average. The only areas of the market in the U.S. that are looking attractive at this point are small and mid-cap. Small and mid-cap from its 52-week high, trading between 15 and 20% lower. So you're approaching bear market territory there. If you have, from an international perspective, international equities have held up much better than U.S. markets. Again, this is as people are starting to rotate out of the high-flying Mag 7 names. We've warned that this may happen, but what do we need to see in order to go ahead and add some more money into the equity market? First of all, if you have cash sitting on the sidelines that you haven't invested, it makes sense to start putting your toes in the water. Start investing, looking at small and mid-cap stocks, looking at international stocks. This is the area of the markets that we think are not only better valued, but also pricing in some of this downside. So we'll continue to look at areas like that. We're not ready to jump into US large cap. We're not ready to jump into growth or technology. The valuations still are a bit too high. We'll also be looking just from other areas of the market. It's not just about equities. We also have a fixed income market that from a yield level, yields have come down significantly. But if you look at things that take on risk, credit, investment grade, high yield, we think that this is starting to widen out a bit. It still is not cheap, but we're watching that closely to put some of our cash to work. Now, we think this volatility, unfortunately, is here to stay. The one thing we have not seen that would make us more comfortable to get aggressive into the sell-off is earnings revisions. We have barely seen earnings revisions budge for U.S. large cap equities. They're down about $1 for this year. So it's not reflecting the deteriorating economic situation that we're seeing. Once we start to see that, we think there'll be better valuations to enter here in the market. We also have, this week is a big inflation week from the economic calendar, so we'll be back to report on that. And then again, we'll keep looking at this very fluid situation from the White House. It's still very unclear. So we're not saying to invest all your money in today just because the tech stocks are down 10%. Instead, we're going to look to gradually add into this weakness, specifically in those areas of the market that may not only be better valued, but reflecting the downside risk that we see in the coming months. That's all we have today. We'll be back again with more of these impact reports. We think they're important to keep you understanding where we are thinking and what we're seeing in the market. And as always, if you have any comments, questions, or feedbacks, please feel free to add that to where you get your podcast. Thanks again. If you want a further history of our podcast, you can go to marketswithmegan.fm. Thank you.